Alright folks, here we are again. Gathering around to watch the European Central Bank, ECB, attempt to tackle yet another economic nightmare, with the same trusty toolbox it's been using since the last decade, the good old interest rate cuts. Seriously, it's like asking firefighters to fight a forest fire with a garden hose. Let's not mince words, dear viewers, Europe's economy is a sinking ship patched together with bubblegum interest rate cuts while the ECB fiddles about trying to avoid catastrophe. So, what's the big hubbub this time? Brace yourselves, the ECB is planning its fourth rate cut this year. Yes, you heard me right, folks. Another quarter-point trim, likely bringing rates down to a lovely round 3%. The reasoning? Well, inflation teeters around 2%, but more importantly, Europe's economy is struggling worse than a marathoner after a pizza-eating contest. Today, we will dive deep into this mess, from inflation to GDP growth, political upheaval, the Trump effect, yes, him again, and what this means for the average citizen and their diminishing purchasing power. Let the fireworks begin. So what is this talk of cutting rates supposed to do? If you roll back the history books, you'll see Europe has been playing this rate-cutting game for quite some time. During the global financial crisis and subsequent euro debt crisis, low interest rates became the ECB's drug of choice. Cut rates to stimulate borrowing, boost businesses, and create some spark of life, right? Well, by now, it's clear Europe's exhaustion runs much deeper than what some rate cuts will fix. We're talking structural inefficiencies here, folks. The magic number this time is rumored to be quarter-point reductions, the fourth this year, which seems to slow Europe's economic deterioration as much as throwing a tennis racket off the side of a cliff slows a fall. Inflation is almost at the ECB's 2% target, and they seem to cling to that number as though it's the last thing Europe has working for it. But what's the ECB wielding these cuts for? Is inflation so frightening? Or is weak growth sending shivers down Christine Lagarde's spine? Europe is no stranger to stagflation, remember the good old days. Low growth, high unemployment, and inflation that just won't quit. And guess what? Policymakers are beginning to fret that inflation might slip below their ever-sacrosanct 2% if something isn't done. But just last month, they were worrying about inflation going over target. It's like playing cat and mouse with a mirage of stability. Now you might ask, is this whole inflation debate overblown? Let's break it down. Inflation hit 2.3% in November, slightly over the ECB's target but not in the danger zone just yet, prompting this next cut. As for any downward revision to these inflation ambitions come 2026, don't hold your breath. A 2027 first glimpse might be the ECB's Hail Mary of economic forecasting. What adds spice to this cauldron of economic woes? Political instability. Yay! First up, Germany. The once untouchable economic giant of Europe struggles with political collapses and an overall loss of direction. France isn't much better off, with governmental crises spiraling like a Netflix drama. Their parliament couldn't even agree on a budget last week, leaving their debt markets spooked so badly that yields soared to rival Greece's. Yes, you heard that right. Greece. Germany's woes, as the proverbial engine pulling the European economy along, Germany tightening up its fiscal belt amid political tensions creates a real conundrum. When the ECB should be worrying about loose policies helping the broader region, we've got Europe's largest economy too entangled in domestic issues to pull the weight. And let's not even get started on the France budget drama. That disaster driving debt yields up higher than a college student's credit card bill shouldn't be ignored. Christine Lagarde, when faced with these haircut-inducing yields, might just give one of those trademark dodges, "Oh, but this isn't a problem we should be using monetary policy to solve." Translation, don't blame us, we just work here. President Christine Lagarde of the ECB has been juggling these rate cuts like they're hot potatoes thrown straight from a financial hellscape. Yet, as much as we talk about economic data and models, Lagarde and her team of policymakers are not blind. They're very much aware that structural problems, high wages, demographic issues, low labor productivity, underpin the slow recovery. But, and it's a big but, none of these are problems monetary policy alone can fix. So what's the ECB supposed to do? They've got no option but to continue slashing interest rates, hoping the floodgates of capital open up just a little bit more. Yet, spoiler alert, those funds are drying up faster than a puddle in the desert. Numerous projections now have Europe's growth only reaching a limp 0.8% this year. Even if officials cling to hopes of growth reaching 1.3% in 2025, who are we kidding? With these repeated rate cuts, it's becoming apparent that Europe's fundamental growth engine is seizing up. No wonder some market experts predict further rate cuts, right down to 2%, by mid-next year. Now, let's pivot, my dear viewers. Put down your coffee for this. How does the ECB's quarter, or half point, depending on JP Morgan's guess, rate cut affect you, on the front lines of Europe's monetary quagmire? Oh, trust me, it matters. For the ordinary consumer, inflation is just the beginning of their woes. Low returns on savings, higher costs of living, and an uncertain future means tightening budgets for years to come. Rising wages? Sure, but those wage bumps will be outpaced by inflationary pressures in energy and food prices, areas where the ECB has very little control. For financial professionals, on the other hand, you've got an ECB-induced headache. The most immediate and tangible effect? Short-term government debt will become ridiculously cheap. Yeah, that's right. Sovereign bonds and treasuries will see yields fall, but prices rise relatively, putting you squarely in an unpredictable, unstable euro market. You thought the volatility over the last decade was fun? Get ready for a rung-up version of whack-a-mole. Not to step on anyone's toes politically, but it seems Europe can't get away from worrying about what Donald Trump ever so kindly called the greatest trade deals I've ever negotiated. Nobody knows what the future of geopolitics holds for Europe's already volatile economy, and the tension with Washington over trade policies could erupt, flinging Europe's fragile situation into even deeper woes. Sure, Lagarde might dismiss the scenario, but it's been seen before. Trade conflict with the US is like re-adding battery acid to a floundering Eurozone cocktail, harmful, erratic, and capable of setting back any positive economic growth projections. To paraphrase Voltaire, if interest rate cuts worked, we'd all be in the land of economic prosperity by now. Europe seems to dance around real problems, structural unemployment, sluggish productivity, energy insecurity, and political instability, while trusting temporary fixes like cuts and bond-buying programs to somehow pull through. Spiraling political problems in Germany and France, continued economic uncertainty globally, trade risks, growth below neutral rates could see Europe's engines stuttering again by 2027. The big glaring hole is this, folks: interest rate cuts aren't going to solve the continued economic malaise that's plaguing Europe. These cuts are just calendar entries for the ECB, while the real threat is stagnation. What we really need is bold fiscal policy, supply-side reforms, and steps to fix Europe's labor and infrastructure problems. So, where do we stand? As ever, we're just watching these rate cuts keep staving off complete economic collapse for just a little bit longer. Aren't you thrilled? But hey, keep your eyes on those ECB meetings because as dismal as the outlook seems, there's never a dull moment in Europe's financial circus. Onward viewers, see you at the next round of rate cuts.